There is a trap being set in the Nikkei 225 right now, and most retail traders are about to walk straight into it. While the weekly chart is screaming strong buy with the force of a freight train, the 1 hour and 5 hour candles are bleeding out, creating a textbook dangerous divergence. Right now the index is hovering at 60,550, and there is one danger zone, 59,933, and one hidden opportunity today. I'll show you both. And if you stay until the end, I'm going to give you 3 exact entry and exit levels you can place immediately, complete with stop losses and risk-reward ratios. Write this down. 59,933 is the number that owns this market. If we lose it, the entire bullish structure built over weeks enters a breakdown phase. Do not take your eyes off this level. Let's get the instant market verdict out of the gate. The session bias is fading, meaning I am treating intraday strength as a sell opportunity within a larger range, but I am fully aware the weekly tidal force is still bullish. That creates a range-bound environment with a bearish lean for the next 24 hours. However, there is one invalidation level that proves this bias wrong, 59,933. If price tests that support and holds with a powerful rejection, the bulls are back in control, and we will pivot to buying the dip aggressively. That is the exact line in the sand. I want you to type that number into the comments right now. 59,933. That single comment will lock it into your mind and show me how many of you are actually paying attention. If we break below 59,933 on a 4-hour closing basis, the whole structure shifts from a healthy pullback to a potential trend reversal, and the conversation immediately moves to 59,490 and even 58,000. But for now, until that break, the weekly trend holds the skeleton together. Now let's go into the technical deep dive, top down, exactly how I'm reading my screens. On the weekly chart, the picture is unapologetically bullish. The Nikkei has been carving higher highs and higher lows, and it is trading miles above the 50-week moving average, which sits near 57,487. That's the MA50 on your daily, but on the weekly it's the same magnetic zone. More importantly, the 200-day moving average down at 52,211 hasn't even been threatened since the big rally began, so the long-term structure is intact. The weekly MACD is still positive, and the trend is officially a strong buy. But here's where the trap gets its teeth. The daily chart has shifted to neutral. The index closed lower by just 0.12%, but it left a footprint of indecision right underneath the MA20, the 20-day moving average at 61,213.68. That level is now acting like a brick wall overhead. Price is also below the 5-day average at 61,525 and the 10-day at 62,221. So on the daily, we are technically in a soft corrective phase within a broader bull market. The daily RSI is at 51.46, completely flat, showing no momentum commitment. The MACD on the daily is still printing a positive value of 1,266, but do not be fooled by the absolute number. The histogram bars are shrinking, and that signals buyers are exhausted. It is exactly the kind of hidden negative divergence that shows up before a multi-day dip accelerates. Most traders miss this because they see a bullish weekly and assume the daily will just follow. That assumption is how you get caught leaning the wrong way into an intraday avalanche. Now drop into the 5-hour and 1-hour charts, and the complexion changes completely. The 5-hour trend is a strong sell, and the 1-hour trend is a strong sell. This means the intraday algorithm is firmly in risk-off mode for Japanese equities. Price is cascading lower in a tight bear channel on the 60-minute chart, consistently capping at the hourly MA20. The MA60 on the 1-hour is sloping down around 61,100, reinforcing the ceiling. This is not a random wiggle. It is a coordinated move where the short-term money is pressing lower right into a weekly support zone, setting up the most violent kind of confrontation between timeframe forces. And when the weekly bullish bias collides with an hourly strong sell, you get a coiled spring. It can snap either way. The two levels I'm watching with absolute precision, support at 59,933 is the immediate floor, and below that, The secondary structural support sits at 59,490.24. Resistance above starts at 61,693 and stretches to 62,136. Those are your boundaries. Any movement outside those creates a runaway trade. Inside those, it is a chop zone, and here is the cross-asset linkage that makes this Nikkei setup far more dangerous than it looks on an isolated chart. The Nikkei 225 and US dollar to Japanese yen have a relationship that is practically symbiotic. When the yen weakens, exporters get a tailwind and Nikkei rallies. When the yen strengthens, the Nikkei gets crushed because carry trades unwind and exporter competitiveness evaporates. Right now, US dollar to Japanese yen is skirting levels that historically wake up the Bank of Japan's intervention desk. Yesterday's session saw Japan stocks lower at the close, and that move did not happen in a vacuum. It was a direct echo of a sudden yen bid during Tokyo hours, likely tied to verbal intervention or Ministry of Finance jawboning. I want you to understand this. The BOJ intervention ghost is haunting every tick of the Nikkei right now. If we get a headline that the BOJ is stepping in to defend the yen, or if US dollar to Japanese yen breaks below a critical figure like 150, the Nikkei will not politely dip. It will gap down and hunt the 59,000 support hard. The two assets confirm each other's moves. So as you trade Nikkei today, you must have a US dollar to Japanese yen chart open. A sudden 30-pip drop in dollar yen that holds will be your early warning that 59,933 is about to be tested, and likely broken. Conversely, if US dollar to Japanese yen stabilizes and bounces back above a key moving average, the Nikkei support becomes a high probability long. The yield differential between Japanese government bonds and US treasuries is the engine under the hood. As long as the Bank of Japan keeps a lid on JGB yields while the Fed stays restrictive, the fundamental pressure is for a weaker yen and stronger equities. But the moment markets sense that the BOJ is truly ready to exit its ultra-easy policy, that correlation flips into a negative feedback loop, and the Nikkei becomes a falling knife. For the next 1 to 2 weeks, my directional lean is cautious but still structurally bullish, provided 59,933 holds on a weekly closing basis. The event that would invalidate my thesis entirely is a confirmed BOJ rate hike signal or a US dollar to Japanese yen close below the 148 level, because that would drain the last ounce of carry trade conviction. Until then, we treat dips as opportunities, but we respect the intraday sell signals. Most people will click away right now, but this is exactly where money is made. Keep watching, because I am about to hand you 3 specific trade blueprints with exact price triggers, stops, and targets. If you are not taking notes, you will regret it. Strategy 1, the sniper, your conservative play. This setup bets that the weekly uptrend reasserts itself at the critical support. The trigger condition is a buy limit order at 59,940, placed just above the 59,933 support, but it will only be activated if price prints a bullish rejection candle on the 1-hour chart, specifically an engulfing green candle that closes above the prior red candle's high, or a long wicked hammer with the body in the upper third. I do not want to catch a falling knife. I want confirmation that buyers have stepped in. The stop loss goes at 59,700, which is below the wick of the hourly hammer and below the intraday liquidity low, giving the trade enough breathing room against a false breakdown. Take profit 1 sits at 60,800. A level just before the MA20 resistance starts to weigh, offering a risk-reward ratio of roughly 1 to 2. Take profit 2 is at 61,500, right at the 5-day moving average and inside the resistance cluster. That extends the RR to well over 1 to 3. This setup is voided if the 1-hour candle closes below 59,933 on strong volume, which would be an early sign that the support is failing and the buyers have fled. In that case, cancel the limit order and wait for strategy 3. Strategy 2, the active trader, a standard mean reversion play for those who want to capitalize on the intraday strong sell bias without fighting the larger trend. Entry condition is a sell limit at 61,200 to 61,300, right at the daily MA20 resistance and the zone where the hourly MA60 is sloping down. You need a bearish confirmation trigger, a 1-hour close below 61,100 after touching the resistance, or a MACD cross to the downside on the 15-minute chart, indicating renewed selling pressure. The stop loss is placed at 61,800, above the swing high and the MA10, a level that if broken would signal a bullish breakout from this range. Take profit 1 is at 60,400, catching the move back into the lower half of the range, and take profit 2 is at 59,950, just above the major support, where you'll want to actively manage the trade. As soon as take profit 1 is hit, move the stop loss to your entry price to create a risk-free trade and let the remainder run toward target 2. But do not get greedy if the US dollar to Japanese yen suddenly reverses. Let's see how aligned we are. Type your Nikkei 225 range for tomorrow in the comments now. Give me a high and a low. I'm reading them, and it tells me exactly what the retail crowd is anticipating before the big move. Strategy 3, the aggressor, high risk, for traders who know how to lose small and manage risk aggressively. This is a breakdown momentum chase. The entry is a sell stop order at 59,920, just below the key support, anticipating a flush and a surge of sell stops being triggered once 59,933 gives way. You will be entering with momentum, not waiting for a retest. The stop loss is extremely tight at 60,300, above the breakout candle's high and above psychological 60,000, because if the break was a false trap, you want to be out immediately with a tiny loss. Take profit 1 is set at 59,500, which is just above the next support at 59,490, and take profit 2 at 58,800, targeting the next liquidity vacuum. This trade carries a risk of massive slippage if a BOJ headline hits, so it comes with an explicit warning, only for those who can withstand a sudden gap against them and who never risk more than 0.5% of their account on a single aggressor play. If the trade triggers, I want you to move your stop to break even as soon as the price trades below 59,700, because a snapback from that zone could be violent. One sentence on risk management, because it's non-negotiable. Never risk more than 1 to 2% of your trading capital on any single position. Never carry a Nikkei position through unscheduled BOJ announcements or major US data without a stop, and stops are not a suggestion. They are your seatbelt in a market that can gap 200 points in a heartbeat. Now let's bring it home. If you remember only one thing from this entire video, remember this. The most critical level for the next session is 59,933. Above that, dips are buying opportunities in a still bullish structure. A 4-hour close below that, and you shift to defense mode, with 59,490 as the next magnet. Tomorrow's focus will revolve around the Tokyo fix and any unscheduled BOJ commentary. Keep an eye on my channel, because I will break down US dollar to Japanese yen in detail and how its moves either validate or fracture the Nikkei floor. Speaking of which, if you want the full breakdown on the Bitcoin and S&P 500 divergence, that video is live right now. You'll see the end screen pop up. It's a must-watch because the risk-asset correlation drama is peaking. Smash the like button if this analysis gave you a clear plan. Subscribe and hit the bell for daily coverage of 8 key assets, because I deliver these market maps every single day. I'll see you in the next one.